month, the Hennessee hedge fund advisory group at Weiss, Peck & Greer reviews the performance of the hedge fund universe, and they look at past performance and at current economic trends in order to advise their clients on their hedge fund investments. And they're very clued in to hedge fund managers. They'll never talk about names, but what we're going to try to do today is to get clued in as well as to what hedge fund managers and hedge fund investors are doing. The husband and wife team who runs Hennessee Hedge Fund Advisory Group is Lee Hennessee and Charles Gradante, and they're joining us right now. Thank you so much.
Good to be here.
I want to start off taking a look at some of the macro funds, because the performance this year, maybe even last year, hasn't been up to the huge returns they've had in years past. Is there frustration among the macro managers? Are you seeing any changes?
Yeah, the macro managers started the year off with a tremendous January, and since then they've experienced a lot of volatility in the markets without a whole lot of direction in many of the markets they're playing in. You know, the bond market has been trading between 6.5% and 7.25%. Commodities have had a little bit of a run in the grains, but that's over. And they're hard-pressed seeing long-term trends, which is really their game. I mean, macros play the long term. Right now, they're seeing a long-term trend in the dollar strengthening. They really feel that the dollar against most G7 currencies will strengthen, and they're playing that play. And they're also playing the energy play because emerging markets continue to have real growth rates, and those real growth rates are consuming a lot of energy, particularly oil, gas, and uranium. Some of the macro managers are playing uranium, which is something that is not too widely written about, but uranium has been a play for several months now.
I think we had seen, I believe it was Soros who was invested in one of the Latin energy companies. Are you seeing the managers getting into things like privatizations of these companies in Latin America?
The macro managers, and I'm not commenting on Mr. Soros and his activities, but macro managers have always been involved in privatization in Latin America. So it's not something new. They may be picking up activity because Latin America has turned the corner in the last couple of years. You can look at their Latin American debt. If there has been any money made in the last 6 months, that's one of the areas where they've made a lot of money in the debt. And Latin American debt sort of indicates the credit quality of Latin America has improved considerably, and therefore the privatization that's taking place in Latin America would appear to be a good bet in view of the debt, and vice versa. I think they both feed on each other. The privatization activity feeds the debt, and the debt feeds the privatization.
Yeah, I know we've seen strength in some of the Latin America funds. Lee, the last time we talked, and it was a while ago, you were talking about macro managers trying to get back to the basics, to what they did best, whether it's stock picking, or bond trading. Are you still seeing that at this point?
I think you're always going to see macro managers go where the opportunities are. There's certainly been some downsizing via capital in some of the macro managers, but the macro managers are still playing all the different opportunities, and still part of being a macro manager is having a very large staff that have analysts in every single area, and the point is go where the opportunities are. And there have been a lot of opportunities in the U.S. markets, for sure this year. And it is disappointing that out of the 17 styles, the macro managers have 15 of the styles that are beating them hands down. The index as a whole is almost double what the macro managers are doing this year. So it is a difficult year for the macro managers because they haven't been as effective in their stock picking.
We'll get to some of the other styles as well, because I know there are plenty of them to talk about. You made a pretty accurate call back the last time we talked about the fact that you might even see some of the funds shutting down, that they couldn't place all the capital. There was some sort of frustration there. We saw Steinhardt closing his fund. Is that trend still going on?
Oh, I think that it's an opposite trend, quite frankly, that there are more hedge fund managers than there have ever been before. And I know our friend Jimmy Rogers mentioned the last time I saw him talking about hedge funds that in the late 60s there was a surge of hedge fund business, and then the business died down. But it's a completely different industry today than it was then. That really was a time where it was just going long in short stocks. Shorting stocks was not an easy. I mean, it was like spitting on the American flag. Today, with the liquidity of the market, the various indexes, the ability to hedge, and so many different instruments, is a whole different ballgame. And I think the main reason that this industry is so driven is because of the economics. You can take a very successful, I mean, think of Vinik, who was running the largest mutual fund in the world, but if you think about, I don't know exactly what he earned, but let's just look at normal hedge fund managers and normal mutual fund manager who might be earning, $600,000, $700,000 a year if he's very successful. And he might be running, $700 million. He might tell you that the day he went over 400 million, his performance went down. So this young man or young woman can, if he's successful, raise as little as $100 million, produce a 20% return, and earn $4 million for himself personally. Now, it's a lot less hassle, a lot more agility, and this is what is pushing the dynamics of the hedge fund industry's growth. There are more hedge fund managers. Even after 1994, when we saw a 15% decrease in the amount of capital in the industry, we still saw a steady 5% growth that year in the number of hedge fund managers. Now we're right back to the capital level that we were after the bond domino crash of 1994.
But I think your comment is well put about the bigger managers. I think Lee's point is that there are a lot more managers coming up into the industry. So the industry is really growing, but the bigger managers are finding it more difficult to handle $2, $3, $4, $5 billion. And I think you see some give back